Hi, class. Hope you're all doing well. Excited to introduce Bill Barhydt as part of week 6 curriculum. Bill, for people that aren't aware, but now will become aware because it's part of the modules, has been an early adopter of blockchain technology, having done, to my knowledge, the first and certainly the most impactful TED Talk on distributed ledger technology through blockchain as an instrument of that. And since then, he's led a market-leading firm that has helped people to get onto various types of cryptocurrencies, has been an exemplar in the space in terms of the right way to do it. Here in California, is super keyed into all of the players in San Francisco and LA. And really, a lot of the blockchain leaders look to him as the right way to traverse the nebulous legal complications associated with trying to do all of these technologies stateside. So super excited to have you on, Bill, and really appreciate you lending your platform and your time to UCLA.
Yeah, thanks for having me. This is really awesome. I'm excited to get into it.
You know, I don't know very many people, even when I go to LA Blockchain Summit or regional events, that have been in it for a verifiable decade. And even the recent comers came in, I mean, they would call themselves OGs, but came in 2017. So talk us through a little bit about how you became enamored with the white paper, Satoshi, and why you decided to go all in.
Sure. I think my kind of roots in the current crypto world go back to the earlier cypherpunk days in the 90s. I was part of the team that created Netscape. We worked on SSL, which is the S in HTTPS, which was one of the first kind of commercial applications of public-private key cryptography, which is the cornerstone of how you sign messages in crypto today. So that's what we mean by using a private key. And so we always had this idea of money for the internet, and no one could ever solve the double spend problem. And most of us, I think, probably thought that it couldn't be solved, given how many smart people tried. And lo and behold, I don't know, 20 plus years later, someone figured it out, and they published it anonymously. Obviously, the history is well known. Published the paper anonymously to this encryption group, which have been a part of for probably 15 years before Bitcoin even. And yeah, I mean, when I first read it, I was like, this guy's crazy or she's crazy. I think they think they've solved the double spend problem, and kind of left it aside. A few months later, revisited it and realized that this person might actually be onto something. And I've kind of been hooked ever since, and just really trying to understand it from every perspective imaginable. And there are many perspectives on trying to understand, first Bitcoin and later Ethereum and smart contracts and how it all fits together, and why it works, and how in like I said, from every perspective imaginable.
What was the reception that when you would bring up Bitcoin at dinner parties back then, as opposed to now? Was there at the time just complete lack of awareness, and now there's like cautiousness towards it? Or
yeah, sure. So in the beginning, I mean, most people had never heard of it. It became a little infamous in the early days because of Silk Road, which was this online website where it was a decentralized anonymous marketplace where you could basically buy and sell anything. And so obviously that would lend itself to things that you wouldn't want to have your name associated with, particularly vices, whatever. And Bitcoin was the currency of choice for that marketplace, and as a result became a little infamous quite early in its infancy. And but independent of that, when I would explain it to people, most people had either never heard of it or maybe had heard of it. And how do you do this without a bank or a trusted third party? And how can there not be a middleman? And how is it safe? People who don't understand tech, and even some who do, you almost have to have a degree in computer science to understand the innards of Bitcoin. It doesn't make any sense that it can work. It does, but it doesn't make any sense to most people. Normally, you have a bank account, which requires a centralized database and a reserve bank to issue the currency and a settlement process between them, and everything flows through them. And this is not that. This is the opposite of that, right? It eliminates all kind of centralized trust in the monetary system, which is the breakthrough in what Bitcoin gives us. So yeah, I mean, it's even to this day, it's foreign to most people. Look, most people don't understand how money works or how banks work, right? So that's not a stretch that people don't understand that. They never have. And so something that's more complicated from a technology perspective, like Bitcoin, it also makes sense that most people won't understand how it works. The question is, as the early adopters decide the future of the internet, what are they going to do, right? And I think they're going to gravitate towards Bitcoin, Ethereum, and similar technologies.
Yeah, so it seems like the earlier cypherpunk communities rallied around it because they could make heads and tails of the ways that it made sense for their ideals.
Yeah, and it wasn't about the value of Bitcoin in terms of like, oh, what is one Bitcoin worth? That wasn't even it didn't even factor into my thinking, right? That came much later. In the early days, it was like, wow, I can do cross-border money transfer. If I'm an immigrant, I can send money home and there's no banks involved. That's incredible, right? And as somebody who's worked to help migrant workers in the US become banked, I can tell you that is an incredibly difficult thing to do because they're not profitable customers for banks. And so having a technology that eliminates the banks is extremely compelling. And so, you know, it's early, right? I mean, the internet was 25 years old before it was commercialized, and Bitcoin is only like 12. And so, but we're on the path. Yeah.
And it's a fundamental storage of value. Like it's essentially a commodity is the way that some government agencies are, but it's also a means of transporting value in the way that really can't be censored. Is the early way that people were starting to broadcast it out in terms of the value, right?
Yeah. At its core, it's just a messaging system. You're moving streams of ones and zeros around, and we arbitrarily give those streams of ones and zeros value, which is, you know, your balance. But that's all it is. It's just moving streams of ones and zeros around. And if you validate the stream of ones and zeros, which is called mining, you earn more ones and zeros in the messages. And as a result, your balance goes up. And at its core, that's all it is. It's just a way of moving these messages around that doesn't use a store and forward mechanism, which is what email does. You store it, you forward it. That's what a mail server does. There's no central server to do that, which is the breakthrough.
Yeah, I think that when people try to wrap their head around Bitcoin, you nicely articulated it in terms of talking about that it's energy, but it's also a ledger and store of value. I think Michael Saylor really hits the point that it's energy as also money. So it doesn't land on people quite as well, but can you clarify a little bit in terms of how like it's the newest iteration of money and how people are rallying around it?
Think of it this way. Why do we need money? Well, historically, right, commerce happened via bartering, right? I would grow vegetables or have a, you know, livestock, and we would trade. Okay. The challenge with that is that there's a mismatch in productivity, meaning I have a lot more of something that's perishable and I need to sell it. And there's a mismatch between how I want to trade. It doesn't work very well. It doesn't scale. And if I'm not participating in the same economy as you, the bartering doesn't really work. And so historically, we've developed money as a replacement for storing productivity. Okay. Because productivity, you know, productivity has a short half-life, meaning it does erode in value over time historically, partially because of the way governments make money, but the value of productivity does decrease over time. And so that's inherent in the way, you know, most monetary systems work. And historically, gold was used as the way of storing productivity. Again, to me, that's what money has always represented. It's a way of replacing barter with a way of storing productivity, or the benefit that you get from your productivity. And so now that's created several problems over time, right? The first problem is that we're trusting and other entities, often governments, but in the past it wasn't governments, it was banks, right? The first kind of credit-based networks were created in, you know, the Renaissance by non-government entities. But historically, regardless of whether it's a bank or a family, in the case of Medici's, or, you know, the US government today, they've always been untrustworthy in terms of preserving the soundness of the money, right? And today that manifests itself by the government just printing money ad nauseum. Or, you know, in the past, fraud or whatever, you know, meaning I tell you I have this much gold in reserve and I don't. And if you're Rome, who's going to fight you, right? So anyway, so this has been a historical problem with monetary systems. which has basically led to the downfall of many, many societies. Ray Dalio writes about this in his latest book, The Principles of the Changing World Order, which is a fantastic read. I highly recommend it. And it really helps you understand why we're in a late stage debt cycle right now versus, the previous cycles we've had. And he explains very well how we're likely to come out of this cycle, and it's not pretty. I shouldn't say likely, but how we may come out of this cycle and it's not pretty. Bitcoin and Ethereum represent a viable alternative to the monetary and banking systems that these systems have historically represented. And so you're no longer storing productivity in a way that's inflationary. You're now able to store productivity in a way that's deflationary, right? Because even gold, we find about 2% of the existing value of gold every year, right? We refer to this as the stock to flow, meaning how many years does it take to double the current supply of an asset? And historically, gold had the longest stock to flow ratio, meaning it takes a long time, but it's not infinite, right? Meaning in a few years, we do double the supply of gold. In theory, Bitcoin and Ethereum are eventually both deflationary. Ethereum's already achieved that. Bitcoin's going to achieve it. Deflationary means that effectively we've stopped creating new Bitcoin or we've stopped creating new Ethereum, and that will happen eventually. And so that means that the cost of goods in terms of Bitcoin should go down over time, right? As opposed to what happens with inflation, where they go up over time. And so in inflation, your money is becoming worth less, on the path to worthless, right? Whereas with deflation, the value of your asset should be increasing over time if it's a scarce float with a large and growing population. Just makes sense, right? It's like collectibles, baseball cards. I collected baseball cards as a kid. What drives the value of the card? Scarcity and population demand. And the more of both, the more scarcity you have and the more population demand you have, the higher the value of the collectible goes. And Bitcoin and Ethereum should function exactly the same way over time.
And I think that it's lost on a lot of our students in the early days how difficult it was to get your hands on Bitcoin. So you could mine it, but at LA Blockchain Summit, they had Charlie Lee as one of the keynotes, and he talked about having to go to McDonald's with cash and then transact and then hope that it would be settled in the way that it was being advertised. Your platform really brought a friendly face and an approachable website to make that happen. So, like, how did you come to acquire your first Bitcoin, or what was that commerce experience like?
Yeah, so I actually mined my first Bitcoin. I think there was a spout that Gavin, one of the early Bitcoin core developers, had created, where he was giving away dozens of Bitcoin. I mean, it was crazy. And then that 50 Bitcoin that he might have given you was probably worth a few pennies, to be clear. Today, that's probably worth a few $100,000, or probably over $1 million now, which is insane. And so there was only two ways to get Bitcoin in the very early days. Somebody gave it to you who had mined it, or there were meetups where you could basically exchange cash for Bitcoin. So you'd bring a phone or a laptop to a meetup, most likely a laptop, connect on Wi-Fi. You'd hand them cash. You'd watch them type in your public key to make sure that the transaction was really happening, and then you'd see it on the blockchain in a few minutes. Those are really the only three ways to get it: gifting, in person, or mining. And I think there was a small few-week period where you could mine from a desktop computer or a laptop, which I managed to accomplish, but then quickly became impossible as the hash rate, grew, or the computing power required to win a new block grew tremendously in the early days, very quickly. Anyway, so then, of course, this website started to pop up that would sell you Bitcoin in exchange for a bank wire or PayPal transfer, or places like Local Bitcoins, where it would do peer-to-peer matching between a party that would sell you Bitcoin in exchange for bank wire and or PayPal transfer or gift card. And those services were ripe with fraud because you didn't know who to trust. And anyway, so then that led to the creation of more centralized platforms, exchanges now, or in our case, banks and wallets, where you could do the same thing, but those became highly regulated once the myriad regulators like, FinCEN and others stepped in and started saying, hey, Bitcoin's a commodity and it's not a currency, and it needs to be regulated as money transmission, et cetera, et cetera. And that led to this kind of centralized, regulated exchange model that we know today.
Yeah, and the wire makes sense because it's going to clear. And then credit cards, I would imagine, are over time would have to be educated, and MasterCard and Visa are now understanding the technology. Your platform was early on getting Apple Pay and Google Pay as a means to deposit. Like, what was that battle like in the early days to get credit card companies to understand that they're giving assets that can be pulled back or charged back in exchange for something that is irreversible?
Sure, it was a slog, and remember, there's multiple constituents you're dealing with here. There's the card networks themselves, who basically create the rules, right? MasterCard and Visa, they have rule books this thick if you print them out that are their network rules. They talk about different merchant categories, debit versus credit transactions, chargeback rules, and it just rules for everything. Rules that have rules, and American Express has this. Discover has it. Union Bank or Union Pay in China has it, et cetera, et cetera. So generally, they will accept virtual currency in the network than they have for, I think, predating Bitcoin. Then you have to basically go to the acquiring banks, meaning who is actually, when you swipe a card, there's a merchant processor. That merchant processor routes the transaction to an acquiring bank that is actually the bank that's taking the risk on the chargeback immediately to process that, and then passes the chargeback on to the issuing bank. So you have all these constituents in the transaction that have to agree to do this, right? And still to this day, several of the issuing banks won't allow it, and some of the acquiring banks won't allow it. But most acquiring banks will, because ultimately they pass the risk on to the card issuer. So for it's incredibly complex, and I probably lost a lot of people even in my explanation. And so I shouldn't have to understand all that to be able to take a credit card payment as it relates to crypto, but unfortunately I do. And so that's the way it goes. And Apple Pay and Google Pay are another layer of complexity, but they was worth the effort because of the ease of use in small dollar transactions.
I know that Stripe has a chargeback protection insurance. Like, are they able to figure this out in any meaningful way, or is it still a battle?
I don't know what they're doing, but it's still a battle. I mean, the chargeback risk that you're taking on accepting credit cards to buy crypto is very high. Because think about it, okay? If you let people withdraw, you have an immediate transaction that hits somebody's credit card. They withdraw the crypto immediately to a hardware wallet, and then the consumer, in theory, has 90-day chargeback rights. Now, we would dispute that if we could prove that you really did it, which in most cases we do, but it's a hassle. Right. So unlike delivering physical goods where it's very obvious what's happening, with digital goods, you really have to dig in and prove delivery and, manage fraud. And there's a lot of fraud in our world because you get the immediate gratification of being able to take the crypto offline. And so you can go on the dark web and you can see all kinds of card numbers that are out there. It's one of the reasons why Apple Pay and Google Pay are compelling, because they actually are way more secure than just entering a card number. Because they actually don't move the card number around. There's a secure element that moves like some card identifier around that's encrypted. And so it's actually more secure. But anyway, it's a whole other can of worms separate from crypto itself that's incredibly complex.
With all the complexities, why did you feel like you wanted to move to make it easier for people to onboard? Like, what in your experience, do you enjoy a challenge? Do you enjoy helping people like disintermediate all of those? Like, why did you start the platform?
I mean, if we're building a crypto bank, okay, and there'll be a day when the traditional banks no longer exist and all banks are crypto banks, and we'll just say bank again. But until that day comes, we need on-ramps and off-ramps between the two worlds. It's as simple as that, right? We have millions of clients in dozens of countries, and they have to have a way of moving the cash from the old system into the new system, and from the new system, in some cases, back to the old system. And if we don't do that, there's nothing they can do. And so it's incumbent upon us to make those transitions on and off, the on and off ramps, as simple and easy to use and as friction-free as possible. And that's what we try to do. And we're constantly improving that, not just in the US, which is actually a pretty complex system, but many countries are easier to deal with. The US has a lot of arcane rules and processes. If you do an ACH in the US, it actually settles in a couple of days, and then you have chargeback rights. And we're like the only country in the world that has that. Like, if you do the equivalent of an ACH in the UK, it settles in seconds. You do even in Mexico, right? Their Spain network, their equivalent of ACH settles in seconds. We've got this backward system here. based upon more or less the equivalent of spreadsheets that banks move around to settle these transactions. And it's like right out of the 1970s, and it hasn't changed. They're trying to change it now, but it's like 20 years too late.
I remember in the early days that a lot of blockchain companies would try to pair up. The idea is that a rising ship like lifts, a rising tide will lift all ships. And so you saw partnerships between Binance and FTX, and then Gemini and Genesis. And the idea is that we're all in it together. But your platform was early in taking a much more like cautious approach and keeping things in-house. Like, do you still like the narrative for the overall industry of supporting other companies, or now that it's gotten so big, is it just so fraught with potential complications that it's easier to do it all in-house?
We have 3 lines of business. We have our retail business, we have our private banking business, which is generally like high net worth clients and family offices, and then we have and many like athletes and famous people as well in the private banking business, and then we have our institutional business, which is mostly traditional banks that are getting into crypto now very quietly, either for trading or for settlement or borrowing against crypto for whatever reason. And those are the 3 lines of business we have. I think on the retail and high net worth business, that's going to move over the next 5 to 10 years to really be based on DeFi rails. And I think you're going to see less and less centralized services. So even Abra as a company, right, we're a centralized company. Our future banking services are most likely to be based on DeFi rails. So if you're moving money around, if you're borrowing against your holdings, if you're sending money to another country, if you're entering into a stock purchase, I believe that most of these transactions in the future will be happening, again, via these smart contract-based DeFi rails that we're all hearing about. Why? They're faster, they're open 24/7, they don't close, right? Banks are closed more than they're open. Think about that for a second. Literally closed more than they're open. Stock markets are closed more than they're open. DeFi works 24/7. It has no borders, right? It's not subject to the whims of tyrannical government control. No one can control it, like the internet itself. And it just works, right? With all of the bad actors that we've seen in our space the last 6 months, the one thing that has remained mostly reliable and safe and easily verifiable has been DeFi. And that was the whole point of decentralized finance, is that you would be able to replace centralized financial systems with these decentralized systems that, again, no off switch, always on, no borders, et cetera, et cetera.
A lot of banks that are testing the waters are going the permissioned blockchain route, like JP Morgan's Onyx, and trying to wall the other entities or other people into like a walled garden approach. So not really using the trustless technology, because they're like, what if the counterparty is the Lazarus Group or some sort of entity that we could have complications with? Like, do you think there needs to be some sort of element there to vet counterparty risk, or generally are the rails so
I don't see the value in permission blockchains. I mean, if you look at historically the growth in RDBMS, traditional database technology, relational database management systems, they deal with this really well. There's an entire sector dedicated to this called EAI, Enterprise Application Integration. There's companies like TIBCO and Oracle, IBM, worth billions of dollars that are way better suited to handle that stuff than blockchain. And blockchain is meant to basically deal with trust minimization and elimination of centralized actors. And even us as a centralized actor, we're simply going to use decentralized technology at scale to create a bank that is more easy to trust versus the incumbents. And so therefore, having a permissioned blockchain doesn't really solve any problems that I can see versus, traditional relational databases and the integration technologies that have been around for 25 years.
A lot of the people that are up on DeFi, will talk a lot about the DeFi protocols and, wanting to use it. But at the end of the day, they're more comfortable onboarding their family to your platform as opposed to Robert Leischler's compound finance or something that's a little bit more complicated. Do you see the need for centralization just being for easy onboarding and troubleshooting?
Sure. Well, let's relate this to the internet itself. Let's be very clear what we're talking about. Okay. It's like saying, would you rather stream a movie using Netflix, or would you rather learn TCP/IP programming and learn how to do real-time video streams using, TCP/IP programming itself? The average consumer wouldn't even understand what I just said, first of all. So they have to use something like Netflix, even though Netflix uses the public internet that itself is always on, no borders, no off switch, et cetera, et cetera. And they, do some IP checking to make sure you're in a certain country. But in theory, they don't really know where you are. They're making a lot of assumptions to say that, you're in California, so you have these rights, because that's very easy to trick the network. Okay. They're just using the public internet to ship that stream to your device, whatever it is, whether it's this phone or this laptop or whatever. Okay. With crypto rails are like that video stream, right? Compound, Robert's company, is a protocol like TCP/IP itself, like HTTP itself, that is meant to be used by other entities. And most of those other entities are ultimately going to be centralized actors. You can use it as an individual with no corporate help, but if you don't have, if you're not, I was going to say PhD, but if you're not very technically astute, you're going to make mistakes and you're going to lose money. So you're going to need banking players like us to use those DeFi protocols like Compound to help you earn yield, help you borrow money, help you make, actually issue loans if you want to do P2P loan to make more money, et cetera, et cetera. And that makes sense. Again, it's the perfect analogy between how Netflix works or, Google and how understanding TCP and HTTP works, right? So again, Compound is closer to the protocol like HTTP, and Abra is closer to what Netflix provides by using the protocol. And that's what we need to make the services viable and easy to use at scale.
So if you were like a number of our students, a senior person at a bank, and you're very knowledgeable about retail banking, you've heard about certainly your program in Silvergate, and you want to be on the cutting edge of the digitization movement that's happening with these large retail facing banks, like what would you tell a traditional banker so that they would generally know what to expect over the few years as banks like yours start to grow in AUM?
I don't know. It's a tough one because, there's other analogies like I just used in the internet world. I'll use voice over IP as another analogy, right? So I remember in my Netscape days, VoIP was very, very new. You couldn't really make calls on the internet yet. And then a few years later, there was Skype, which was the first, decentralized VoIP service. And then other platforms came along, and we would have these meetings with telecom companies, and we would say, look, VoIP is going to eat your lunch. And they're like, yeah, whatever. It doesn't work. The service quality is awful. And guess how we're communicating right now? Not only is it VoIP, it's video over IP, right? And there's no telecom involved. I don't get my home internet from a telecom provider. I get it from my cable TV provider, right? So they're done, right? The only value they provide now is the pipes, the towers to make the iPhone work when you're not on home Wi-Fi. That's it, right? And so that's what's happening to the banks as it relates to DeFi and similar services. So when you have the same conversation with them, they're like, yeah, it doesn't work. There's all these rug pulls. People are losing money all the time. It's insecure. And it's exactly the same conversation I have with the telecoms. 10 years later, right? They're not adding value. And so I believe that's what's going to happen to most banks for the same reason. And it's just the way of things historically when it comes to massively disruptive, exponentially growing technology. And this is going to be no different.
So reading the press or reading to see what banks that are trying to adopt this ultimately do, and then seeing how it's applicable to them. I think many of them already have, let's just say a bank that will have like an investment arm. So they may point people that want coverage for their retirement, and they'll be sold usually through a separate vehicle like Bitcoin or given access to digital securities. And so it would be that encroaching over to their coverage where having an awareness of this so that it's not altogether new to them when the tsunami starts to hit and they can pivot with it, right?
Sure. I mean, there's investing in the technology, which is what you're describing. And then there's rebuilding the infrastructure of the financial system using the technology, which is what gives it its value in the first place. or long-term value in the first place. And for most people, if you want exposure to the asset class, it's very easy. Just go to abra.com or Coinbase or wherever, and we can get you exposure to Bitcoin, Ethereum, or whatever. It's very straightforward using your bank account, like we talked about earlier. The bigger issue is, how are banks going to be rebuilt from the ground up, just like using the internet, and not just to provide access to your bank account. That's easy, right? In the back end, it's the same mainframe systems it was 40 years ago. I'm talking about rebuilding these systems from the inside out, using money for the internet like Bitcoin, using smart contracts that enable DeFi, et cetera, and they don't have the first clue. And I wouldn't expect them to, just like the telecoms didn't have the first clue about voice over IP and the fact that it was going to kill their core businesses over time. I was explaining to my kids, by the way, that you would actually pay per minute for long distance calls. And they said, well, that doesn't make any sense. Does it cost them more to, now they didn't use the word terminate because they wouldn't know how to describe it. The word was terminate, a long distance call to establish the connection. They said, of course not. The cables already exist. It's a circuit. And they said, well, why would they do that? And the answer is because they could. And well, now they can't because no one would pay it. Right. And so that's how banking systems are now going to evolve, when people realize they can have 24/7 access to basically earn yield, make loans, make deposits, send money. Wires don't settle 3 hours a day, they settle 24/7. There's no more wire, by the way. You just move crypto around and it's a stable coin. The dollars that you move over here settle over here. Nobody is going to accept the traditional banking model 6-7 years from now. And that's how fast it's going to change.
You've been a leader on a lot of these issues. Jamie Altair has been talking a lot about this in the context of his reserve currency. Mm-hmm. And I think you had some nice back and forths with him, but I think overall you're skeptical on CBDCs as a solution, either by the US or other countries. Is that generally the way that you color that type of stablecoin approach?
Well, let me explain what it is, and then I'll explain what it does, and then give you my concerns. So what is a central bank digital currency, or CBDC? It replaces the paper money that you have with money that is issued digitally. Now, we don't have that today. We have stable coins, which are a different thing. Stable coins require the same amount of cash in a bank account, right? And then you get a token, crypto, that equals the value that's in the bank account. A CBDC replaces the paper in the bank account, and the token is the cash itself. Okay. Sounds interesting, sounds useful, right? Easy to move around. Why is that a problem? Well, first of all, it doesn't change the monetary system itself, meaning that today our government, through quantitative easing, has increased the money supply more over the last 10 years than it did in the previous 100. Actually, probably in the previous 200, okay? And nothing in the rules stops that, right? So all the flaws in our monetary system remain. You can just make the money faster, all right? So there's a misconception that moving to a crypto model might fix the money system. It doesn't. It's the same, flawed system with a nice layer of paint on it. The second thing it does is it really makes it super easy for the surveillance state to track the movement without the banks of moving the money around. So if I go to Starbucks and pay with a $100 bill, or it's not $100, $20 bill, it's very difficult to know at scale where that $20 bill came from. That it was Bill or somebody else. And that's my right. I shouldn't have to be surveilled to be able to use my paper cash. It's always been our right. Okay. Central bank digital currencies undo that and make it trivially easy to track at the IP address level and potentially at the individual named consumer level via social security numbers or whatever, the movement of these digital tokens between any two entities, person to person, entity to person, person to entity, entity to entity, whatever. And of course, they're going to do it. If you give a government entity the power to do something, they will take advantage of that power. And I'm not even talking about it in evil terms. It's just common sense. It's, so for this reason, I strongly prefer the stablecoin route versus the central bank route for a few reasons. One, there's way more competition for companies creating these stablecoins. It enables privacy tokens to be used as stablecoins, right? And it's very easy to integrate privacy features into these stablecoins so that your IP addresses can't be tracked, your name can't be tracked, et cetera, which makes it function more like cash. Okay. And it still functions 24/7, it's always on, et cetera. So sorry for the long answer, but that's where I come out on this.
Yeah. So you're not a big fan of algorithmic stablecoins or any of the the more sharp ones.
So that's different. Algorithmic stablecoins is something we've had for decades, right? In capital markets, you can create synthetic assets using derivatives, and that's been done many, many times. The question is, can you create stable synthetic versions of monetary systems without having a bunch of dollars in a bank account? That is very hard. Keeping the value truly stable without 100% reserves is extremely difficult. And if the underlying asset you're using is not stable itself, you've compounded the problem. So in other words, I could actually create a stable dollar using gold. How would I do that? Well, if I had $100 worth of gold in my hand, if I shorted the gold in that moment, the gold would always be worth $100, because if the value of gold went up, my short would lose money, but the value would still be $100. And if the value of gold went down, the short would make money, and the value of the gold would still be $100 minus the cost of the short. Okay. But the value of gold is relatively stable over time. If I choose an asset to create the synthetic dollar that's incredibly volatile, right, that short's going to fail. So if the value of the asset goes to zero quickly, I can't get enough of that asset to make myself whole again. And that's what happened last year with this Terra Luna collapse. And it's funny, I had the founder of Terra Luna on my Money Talk show, and I asked him this question. I said, if Luna goes to zero quickly, you can't make everyone whole. He said, yes, that's right. And I said, well, why are you choosing to do this with an asset that's incredibly volatile? Why don't you just use Bitcoin or something else? And the answer was there's no mechanical way to do it. No one's figured out how to do that in a decentralized way yet, right? The only way to do that, we did it. We created a synthetic dollar using Bitcoin, but you had to trust Abra, to maintain the shorts. Anyway, it's a complicated topic, but the bottom line is no one has figured out how to create a synthetic dollar using an algorithmic model that you're describing.
I think the bear economy, just like when Bitcoin was founded on the heels of the financial crisis, that now we're seeing a lot of financial pain that's bringing people off of the salary rolls of traditional Web2 companies. So like 12,000 people just got fired from Alphabet, and a lot of people are thinking about coming over to Web3. Like, what would you tell someone coming from the world of Web2 or the early internet that's trying to carve out a career in Web3 overall, just an open-mindedness for disruptive technologies? Or how would you advise someone that wants to be successful?
Yeah, I'm a little weary of the monikers, Web3 or whatever. It's fine. We need to be able to explain things, so I get it. But I tend to focus on problems, meaning where are the big problems, right? And what problems is the technology solving? What problems is the product solving? If you're gravitating to a specific entrepreneur, what is the entrepreneur passionate about, and what problems are they solving, right? Bitcoin solves regulatory arbitrage problems for moving money around. It solves, store value problems at scale. If you're in countries where the banking systems and monetary systems have basically broken multiple times, Argentina, Venezuela, Turkey, or war zones like Ukraine, it's obvious to the population why they would want Bitcoin. Obvious. You don't have to explain it. Okay. It's, Shimad Palihapitiya calls it schmuck insurance for governments run amok, and it's accurate. Right. And so Ethereum solves the problems of banking systems having borders, having closing hours, not being interoperable, wires taking days or a week to settle, FX fees between government issued currencies, manipulation of the FX systems, et cetera, right? So it's very easy to articulate to people that understand what the problems are that those technologies solve. And for people who want to get into the space, what are you excited about and why? Even if it's games like digital collectibles, it's very interesting to have digital collectibles that, don't have a central trusted party. But what problems are you solving? Do you need this technology to build a better game? If you don't, well, why are you doing it? Right? Are you solving a problem with your permission blockchain at Chase or whatever bank is using it versus an Oracle database? No. Well, why are you doing it? Because it's fun? Well, that doesn't make any sense. So you're wasting somebody's money, right? So if you focus on that, usually either good things will happen or you'll avoid wasting time with bad things, maybe.
How do you choose what altcoins that you'll allow on your platform for staking?
For staking, demand mostly. They have to be supported in their trading system, in our trading accounts, Abra Trade. And then if there's enough demand, we'll look at adding them for staking to earn yield. Staking, for those who are not clear, it's just the ability to earn more of the asset by holding it in a certain staked wallet. And I think, do this with 5 or 6 different cryptocurrencies today. And then you can also earn yield on a bunch of other cryptocurrencies through our lending system. But yeah, it's mostly demand, and we're constantly looking at adding more, and we will be in the coming weeks actually announcing that we're adding more. And like I said, it's driven by mostly user demand.
Do the most groups that want to hear from you and hear about your platform in technology circles, banking circles, or who are most interested in like having you speak or interested in kind of what you're doing as an emerging platform?
Yeah, it's a good question. It's really 3 buckets. I would say it's technology enthusiasts who want to understand the future of this stuff, who believe that the monetary and banking systems are broken. That's easy. It's banks themselves, financial institutions, traditional finance, trading houses, banks, but financial institutions is one big bucket, who want to understand, okay, Abra is a leader here. What does the bank of the future potentially look like if we're right? Right. And then the third bucket is investors, right? We have a lot of high net worth clients in our system, a lot of famous actors, athletes, whatever, that are also clients. And we have a private banking group that spends a lot of time educating that investor base on how this all works and how they can kind of add exposure to this world to their investor portfolios as well.
Probably the number one reason besides DeFi or banking that people will enroll in this coursework is for DeFi. I'm sorry, for NFTs. I see you have a Bored Ape Yacht Club NFT in the back. And so your overall thought is that if the technology can use the rails that are there to distribute the art or make something of it, then it's a good application of the technology, but don't try to overcomplicate it in the way that an Oracle database would be able to. Or what are your overall thoughts on NFTs?
Absolutely. So a smart contract, which is what Ethereum code is basically just a bunch of code that does something on the network. And instead of running on a central server, it just runs on the internet itself. And these smart contracts are getting traction in a few different areas. Stablecoins, which is, all stablecoin is it's just smart contract code that gives you right to a certain number of dollars that are stored in a bank account, right? DeFi is decentralized finance apps are just smart contract code that basically move money around in the form of Ethereum or Solana or BNB or whatever chain they're running on, to cause money to move based upon this loan, this peer-to-peer money transfer, a yield payment, whatever they're doing. NFTs are also smart contract code that basically store your rights to something. That's it, right? And those are unique rights, which is why they're called non-fungible, right? So those unique rights could be your rights to that JPEG. It could be your right to enter my house as a key. It could be your right to an insurance policy, your right to this driver's license that says, oh, this is Bill, right? And so it's just a way of encapsulating those rights digitally. And to your point, yes, you can do that in an Oracle database, 100%. But then you're trusting somebody else to store those rights in a way that's immutable. and you can never prove that they can't change it. Whereas the beauty of storing digital dollars as stablecoins, NFTs on Ethereum, is that they truly become immutable. Meaning, once I have those rights to that JPEG, you can't change it, right? And that's the value that we get in doing it on Ethereum versus in an Oracle database or any database.
Yeah. Speaking of Oracle, I think most of the people that I've helped get placed out of the certificate program was into enterprise blockchain. So in California, as you know, like there was a chart, I think 90% of the biggest tech companies are stateside. But if you look at the top 20 cryptocurrency platforms like Sans, Ripple, or a few other ones, like they're around the world because the regulatory clarity is not here. Like, is that the final piece of the puzzle that could make the US relevant again when it comes to a lot of these emerging technologies?
It's a good question. A lot of people right now, their biggest fear in starting something in the crypto space is even accidentally creating a securities offering, right? So securities offerings in the United States are highly regulated. Generally, they can either be done via registration process with the Securities Exchange Commission, SEC, or offered to what are called exempt investors, usually accredited investors. And that's not what startups are signing up for when they're creating these protocols. And so as a result, because of these draconian rules that are unclear in many cases, they've chosen to start these companies outside the US, get the protocols going, prove that they're not get the utility going so that it's clear that they're not securities, and then hope that as a result, they're not running afoul of US securities laws. And that's worked in DeFi reasonably well. It's worked in the NFT space reasonably well. In the stablecoin world, companies are just partnering with banks and becoming money transmitters or trusts, and that's also worked reasonably well. And then there's a few companies that have taken the approach that my token is a security and they've registered, or they've said, here's how I'm only dealing with accredited investors, or whatever the case may be. So that's the biggest challenge in terms of new companies wanting to launch or being willing to launch in the US versus other countries. If you're just starting a Bitcoin miner, it's easy to start it in the US. It's expensive. It's incredibly expensive. And there are laws you have to deal with, but it's very clear, right? You know what you're doing from a legal perspective. You can lawyer up, you pay up, and it's fine. It's the securities laws that scare most startups.
Recently, I've seen a lot that's going on with fractionalization. So like Masterworks fractionalizing art, or Securitize as a platform, having KKR, big guys, fractionalize their funds. Is that an interesting use case you're keeping your eye on, or has that been around for a while? It's just,
look, I mean, taking an NFT, which is a single NFT, which is a commodity, and turning it into securities is an interesting concept. Same issues I just talked about in the last question, but it's going to happen. Look, if the use cases for NFTs haven't really even been hashed out yet. I mean, everybody's been focusing on art and digital art, JPEGs, and all this fun stuff because it's easy in terms of getting your arms around, and for most people, easy to implement. But even digital collectibles, which isn't really a thing yet, Topps and NBA and NFL are starting to dabble in digital collectibles via NFTs. It's brand new, and people haven't really thought through the implications of that yet. And the first iterations are not good, in my opinion, versus just paper, cardboard cards. But they will get better. I think they will get better quickly. I think what Gary Vee is doing with VeeFriends is very interesting. But there's 1,000 use cases that have nothing to do with art. Nothing, right? Coupons, tickets, keys for your home, I talked about, driver's license, identifiers, things that you can't transfer. And I'm sure I'd come up with another 100 use cases that people are not focused on yet. And we'll see what the value proposition ends up being for being able to create on-chain digital versions of these things, whether or not that adds value or not. I don't know. But for me, when I think about it, I'm kind of thinking out loud here, but if I have things that basically become stateless in terms of not having to trust the government, if I have a way of verifying that it's Bill that doesn't involve the US government, there will be use cases where that's interesting, I promise you. We just haven't figured out a way to integrate the physical world with the digital world. Because right now, if you're going to create a token that says I'm Bill, you still have to trust somebody to verify that it's Bill, right? There's no way to do that in a trustless model. And that's where crypto tends to break down, is when you have to integrate it with the physical world, right? Like, we're trusting the bank that the number of dollars representing those stable coins is really there, right? The stable coins themselves, the tokens, are trustless. The bank is trusted, and it needs to be, otherwise it doesn't work. And so that's where we still have issues. We haven't figured out how to bridge the gap between the physical and digital world in a way that eliminates centralized trust. And maybe we never will. That's just the way of things, right? Bitcoin is the most pure, digital asset system we have, because there's zero centralized trust anywhere in the system, right? Whereas all the use cases that are proliferating for Ethereum so far do involve integrating centralized trust back into the equation.
Which, like oracles, can be potentially messed with. So even if a metaverse doesn't scale in the way that many are hoping, the digital identity front is interesting if you can pair it with a provable way, like having your coworkers or friends that this actually is Bill, in a way that's reasonably passes the smell test, could be interesting.
Yeah, that's right. And look, I mean, there's so much work being done in so many different aspects of this, whether it's digital identities or just other aspects of the centralized trust here. Interesting solutions to a lot of these things are gonna be worked out over the next 10, 15 years that I certainly haven't thought of. And it's going to get really interesting.
In our last presentation with Pat Doherty, he laid out how essentially 5 of your competitors are now in embers with their staking platforms. So I would imagine you're getting a lot of more customers that are just looking for any sort of coverage. So can you spell out, like, what do you see the next 5 years holding for your platform? Like, where are you trying to take this leadership position now that the bear market is here, and then when it assumedly goes up, then you're well positioned to sweep up?
Yeah, I mean, it's crazy. Almost all of our competitors are no longer in existence, just given what's happened in the market. And it's really been our risk management and technology systems that have allowed us to thrive in this environment when the others haven't. And we kind of predicted this was going to happen when we saw the pace of what was happening and the lack of kind of risk controls. And similar things have happened in the traditional banking world. There was a company, Long-Term Capital Management, which was a prime broker in the banking broker in the early 2000s, sorry, that blew up. Very similar to what happened in our space, just different products, right? Equities as opposed to crypto, and doing exactly the same things that the companies that died in our space were doing. So the problems weren't crypto specific. Crypto made it faster. It accelerated everything. So to us, the question becomes, okay, great, we're here. That's good. How are we going to help rebuild trust that people should use this stuff? Now, that's ironic, given that the whole point of this is to make it trustless. But as I said, if we don't exist, the average person can't use this stuff. It's just too complicated. And I have arguments about this with my friends who don't agree with me all the time. They said, oh, anybody can use Bitcoin and Ethereum. And that's just not true. I can give you a list of people I know who there's zero chance that without my help, they can't do it. That they just can't. And so anyway, the point is, how are we going to basically regain this trust so that as people are using this next generation banking service, get a loan, move money around, earn yield on their dollars, that they just trust it automatically like they would any bank? Well, we're getting bank licenses in several jurisdictions, including the United States. We announced several months ago. The US license we've been working on for over a year. I believe that bank will mostly use DeFi rails probably within 3 years, actually. And so that you can actually go online and verify, right, how much capital is in these DeFi contracts, how many loans we have outstanding, how much collateral have we collected for the loans, how much yield am I earning, and where is it coming from? Is the money that Abra says there really there? And you can verify it on chain. That's what it's going to take. Nobody does that today because no bank or even exchange for that matter, is based purely on DeFi systems. And so, but I think that's what it's going to take. And that's what we're working towards. And so at that point in 2023, so in 2026, 27, 28, you now have a banking system where if you're not doing what you say, some kid from MIT is just going to go online and say, hey, this bank says they're doing this, but they're not, because I can see it right here online. And so you're going to know who to trust and who you can't. And so the quote is going to, or the mantra is going to be, don't trust, verify. Right. And that's what DeFi enables. And that's what we're moving towards at Abra.
How can people follow your thought leadership on all this? Like, what are your preferred channels?
Yeah, I'm reasonably active on Twitter, not every day, but you know, I try to get on a few days a week. I'm Bill Barhydt on Twitter. Obviously, you know, Abra's online as well, easy to find. Abra.com. We have a bunch of content on our YouTube channel. I do a weekly show where I try to do it every week. Most weeks where I give just kind of a quick update on what I'm seeing in the markets, what's new at Abra, what's new in crypto, my reading of the macro tea leaves for those who are interested in that kind of stuff. But you know, we're out there. We're very easy to find.